I'm Scott Inman, and welcome to this Fastest 4 Minutes in Finance Extra. A little bonus content for you this week, especially with all the turmoil, all the additional market volatility that's been going on. We thought we would spend a little extra time diving in and talking a little bit about the value of staying invested and long-term strategies and how historically they have paid off. We are pleased to be joined by Ryan Detrick from LPL Research to help us break that down. And really, it just kind of, Ryan, delves right into something that your team produced. I guess it was just earlier this week, maybe a week or so ago. 6 charts focused on the long term. You know, we preach all the time here that you can't make a short-term reaction that impacts your long-term plan, and this is certainly a time to remember that after one of the worst starts to a year ever for the stock market. So, if it's okay with you, we'll just dive right in and go through these charts one at a time.
Well, absolutely, let's do it.
Okay, so chart number 1. The farther out you pull a chart of stock performance, the better it looks, is basically the takeaway here. And even the major economic crisis of the day is barely noticeable. We hope that's the case very soon for this one. Walk us through the first chart of the Dow Jones performance over time.
Yeah, Scott, the Dow's been around a very, very long time. But like you said, historically, tends to go up. You know, about 3 out of every 4 years, the stock market's usually up. Now, it doesn't mean, of course, every year has to be up. Think about the last decade, right? 2011 stocks are flat, 2015 stocks are flat, 2018 stocks are down a little bit. Yet the S&P, we got the Dow on here, but the S&P was up over 400% during that big bull market. So again, it's just so important to remember. I love the saying, I probably said it on the show with you before, the stock market's the only thing where things go on sale and everyone runs out of the store screaming. I love that quote because, again, there are some sales right now. I mean, the market's pulled back, no doubt about it. When you have this context that, listen, I'm investing for the next 5, 10, 15, maybe even more years, things are usually going to come back. In fact, they always have, right? One of the few certainties with death, taxes, and the stock market eventually making new highs. I mean, that's the third one people kind of forget about. It's just maybe it takes a while sometimes, but it does, and that's just so important for investors in a longer term point of view to remember.
Yeah, there's no question about it. Stretching that out really lets you see us climb that staircase a little bit better. All right, so the second chart, and we say all the time that anyone who has bet long term against the U.S. economy has lost. And this next chart, I think, backs that up. It encourages us to believe in American companies to make money over time. Talk about it.
Exactly. I mean, stocks just don't go up just because. They go up for certain reasons, and we think one of the main reasons is earnings. If companies are making earnings like they are right now, right? Usually the economy's doing pretty good, but stocks do well. So this chart, we don't quite have 120 years worth of data back when Charlie Dow started the Dow. I think it was 1890. I think it was May 24th, 1896 is actually when the Dow started. But anyway, so this is about 70 years worth of data. Earnings go up about 7.5% on average per year versus stocks that gain maybe about 9 to 10% a year, give or take, total return. But earnings usually do pretty well. And that's another key driver people just need to remember. Look, last year, I mean, earnings went up like over 50% last year. This year, they're probably going to gain about 10%. That's still better than your average year worth of earnings. And I know all the scary headlines and things that are happening. But again, earnings justify stocks and stock valuations. And to us, earnings still are strong. And we're in the middle of our last comment on this. We're in the middle of earnings season right now. All right. There have been some high-profile misses, yes, but overall, corporate America has been quite optimistic about the future, and they've been increasing earnings guidance this year. Earnings estimates are up about 3% since the start of the year. It doesn't sound like a lot, but look at the headlines we've seen. That's impressive. And when all is said and done, we think will suggest that this extreme fear and volatility we've seen so far this year will probably have been an opportunity for longer-term investors to buy some things on the cheap, and earnings will justify.
We say it all the time. We believe stock prices will eventually return to fundamentals. There are short-term fits, we'll say, that the market goes through, and that's what's happening right now for sure. I love this next chart number 3, about missing the best days in the market. And boy, what a week to really bring this out, right? I mean, we saw how this could work just this week. If you had decided to get out of the market, and then you saw that the Fed announced a 50 basis point rate hike and a huge surge in-market returns. You'd have missed that, but maybe got enticed to get back in, and then the very next day, the bottom drops out. And you'd have taken a beating by compounding losses, and this chart shows us even missing a couple of days like that over a long period of time could be devastating.
That's right. We went back to 1990. Which actually is interestingly, the last year my Cincinnati Reds won a World Series. If you've seen the Reds are defying all odds by losing every game, but we're not going to talk about that. It's too depressing. Anyway, but stocks historically gained about 10% since then. But Scott, if you just missed one day a year, the best day, again, this is suggesting don't market time. I mean, it's a very difficult game. You missed the best day, your average return goes down to about 6%. Per year. That's a huge drop. If you miss the best 3 days, you're like break even. Since 1990, you're break even. The huge gains we've had since then, but you're virtually break even, okay, if you miss the best 3 days. That's incredible. And if you were to miss the best 20 days, just to really hammer home, best 20 days a year, you're down compounded about 24% per year. So again, it's not easy when the headlines and things are out there. We fully understand that and feel what a lot of investors are feeling. But it's so important to remember that sometimes investors are their own worst enemy. I say, I can't take it anymore. I can't take it anymore. And then you want to get out. And that's when you know some of the big gains can take place. And when you miss some of the best days of the year by market timing, you're going to be behind the eight ball, Scott, more often.
Did you add another to the certainty list? Death, taxes, S&P 500 making all-time highs, and the Reds missing the World Series? Let's hope not.
Yeah, I tell you what. Compliance hates when we make guarantees, but I think I will make a guarantee. The Cincinnati Reds will not make the World Series this year. That could be one of the easier predictions I've made in my 20-something year career.
There's always next year. That's the saying too, right? Well, exactly. So we've certainly had some client portfolios that have been negative over the past 12 months. There's no question in our reviews we're seeing that with stocks and bonds. Even a diversified portfolio is pretty ugly right now. But our next chart, I think, should encourage us that it's not all that common over a 12-month period. The S&P 500 historically has been positive the majority of the time, even in a shorter time frame like a year. But I guess really the headline here, Ryan, is staying the course over the long term increases your probability of positive returns.
No, it sure does. So going back to 1950, we found, I think I mentioned this number a minute ago, your average year's up right about 3 out of 4 times. 74% of the time, the S&P is up 12 months later. Pick a random day, and it's up. But the good news, and again, well, let's show the bad news. The bad news, that means, 1 out of 4 times you're down. That's probably where a lot of investors feel and are right now. But if you're willing to hold, Scott, just 3 years, that jumps up to 84% of the time the S&P is higher. Go out 10 years, 92% of the time the S&P is higher. If you're willing to hold something for 15 years, we get it. It's a very long time. But the S&P has never been lower by any day, by the peak in 2000 or the peak in 87 before the crash, whenever you want to buy. Some of the worst days possible. If you're willing to hold, 10 and 15 years later, you're probably going to have some gains. And that's if you buy at the peak. Just think about if you buy something when it's on sale, like right now when stocks are down, ballpark 15%, NASDAQ's down even more. You're buying them on sale. These numbers actually get even much better, right? The returns are much better if you're willing to hold for a long period of time. Just so important for investors to remember. I do this for a living, and you do too, right? The headlines are scary, like, oh my goodness, GDP and this and that and the Fed. It is scary, but then you got to take that step back and realize it's a marathon, not a sprint. Very cliche to say, but stocks tend to do pretty well if you're willing to hold them long enough.
Well, this next chart is a little more complicated. It shows the relationship between a stock's valuation and its performance. And really, to me, I guess it points out that stocks are cheaper today than they were at market highs. And as you kind of talked about, being willing to buy when things are discounted, does this signal a buying opportunity for investors?
Yeah, we think so. I mean, again, a simple way to put it, when stock, I keep this real simple, but there's something called the PE multiple, right? Price to earnings multiple. What you're willing to pay for a stock relative to how much it earns. Well, if you're willing to pay, when stocks are really pricey, not too surprisingly, the returns going out into the future, 5-10 years later, aren't quite as good. But when things are cheap, returns get better. I think most investors understand that. But here's the key concept. Coming into this year, all right, the S&P 500 forward, the forward PE multiple on the S&P 500 was up over 22. What in the world does that mean? Well, that's pretty high historically. We said, listen, there's some worries out there. One of them are stocks aren't cheap. I mean, that was the truth at the start of the year. Now we've had this big, good-sized correction, and earnings estimates have gone up. So stocks are really cheaper, much cheaper than they were at the start of the year. So it makes sense now that, again, if you don't think there's a recession on the horizon, which we don't, if earnings are continue to be strong, like we think, the consumer is still healthy, corporate America is still in good shape, all these things are what we're seeing still. Stocks are cheaper. Now's a really nice time for investors. Again, think about that. Don't run out of the store screaming just because things are on sale. Use it as an opportunity, and things are on sale here, and that's a good thing for longer-term investors.
All right, our final of the 6 charts, and it's certainly been painful to watch account values plummet in 2022, but our 6th chart shows us that we should expect this almost every year, in fact.
Yeah, that is the truth, right? So we've actually seen 2 10% corrections now this year. I think the chart only shows 1, so we've had a second one just recently. But the average year sees at least 1 10% correction. Here's a really interesting stat for you, Scott. The average year since 1980 on the S&P has had a 14% peak to trough correction on average, okay? 21 years since 1980 had at least a 10% correction during the year. Here's where investors need to know. 12 of those times, more than half the time when stocks had a 10% correction at some point during the year, by the end of the year, stocks were higher 12 of those times. So it's really uncomfortable how bad this year has started with this pullback that we've seen. Ballpark, we pulled back about 14% on the S&P 500. That's about your average year. It's just it all happened really early in the year that makes it so uncomfortable. And again, historically, with those years that pull back a lot, they can come back if you avoid a recession. So these are important concepts for your average investor to realize. This year has been tough, but it might have been a gift to a lot of investors to buy things on the cheap in the face of what is still a pretty strong economy, in our opinion.
Ryan Detrick from LPL Financial, thank you for the hugely valuable perspective that you gave us here with 6 charts focusing on the long term. And thanks for joining us for this Fastest 4 Extra, Ryan.